Hello, international finance students. We'll pick up where we left off, talking about the forward market. So, the forward market for foreign exchange is, in some ways, very similar to the spot market in that you have all of the same kind of direct and indirect quote infrastructure, and you have, the same sort of liquidity concerns or non-concerns depending on the currencies that you're transacting. There's some extra layers too, right? So a forward currency transaction is an agreement to transact at a specified exchange rate at some point in the future. 1 month, 3 months, 9 months, 12 months. So again, this can make a lot of sense if you know that, let's imagine an industrial firm knows that it will need foreign exchange at a particular point in the future because of an order being completed and accepting delivery, and they would prefer not to be subject to foreign exchange risk between the time of initiating the order and the time of completing the order. And so they might enter into a currency forward agreement accepting delivery of currency at a particular exchange rate, and then when that time arrived, do it. So it can be used to hedge, right? So in that case, that's a hedge transaction because we have an actual real economic transaction on the one side and then a forward on the other to reduce exchange risk. But it can also be used to speculate, right? If I enter into a forward and then the spot rate moves up, then if I'm purchasing a currency and then the spot rate travels up, if that currency that I was purchasing strengthens, then my forward will permit me to purchase that currency at cheaper than current market rates. But if the currency weakens, then it will compel me to purchase that currency at higher than current market rates. So there's, if we look at the way this sort of maps out, it looks like this, right? So you have just a linear increase dollar for dollar in spot relative to the profit on the forward. And right, if you took the long position in a currency, then you profit if that currency declines, right? Because goes up because you're purchasing it and you're purchasing it at a price fixed before the increase. So you benefit from that increase. And then if you take the short position, you benefit if that declines, right? Because it declines and you can purchase at a lower price. Since both the long and short position and forward have both a winning side and a losing side, it's a forward is typically constructed to not exchange any money at the time of inception, right? So they're a zero. Basically, it's just a commitment that you sign, that an organization signs to another organization, and it's just it's an agreement with zero value to transact at some point in the future, and that the fact that it's zero value depends on the path of expected future spot rates. And so if we go back here and look, so there are some examples of some quotes. So here we have the dollar to franc exchange rate, right? And we can see that the so it's $1.018 per franc in the spot market, but that this is increasing as we go forward. So basically it's buck for buck today in this example, but francs are $1 6 months forward. And so that means that the market expects, in a way, the franc to appreciate against the dollar, right? In that it costs more dollars to buy francs 6 months in the future. Now that's so that's not necessarily true, actually, to a great degree because of interest rates, right? So if prevailing interest rates for dollars are 2% and prevailing interest rates for francs, well, so let's say prevailing interest rates for dollars is 4% and prevailing interest rates for francs is 2%. So if I own dollars, my $1 will turn to $1.04, and my 1 franc will turn to 1.02 francs. So if I transact in the spot market and trade my dollar for a franc, I end up with 1.02 francs. If I keep my dollar, I end up with $1.04, but I have to transact at that forward rate of $1.02 per franc, and so I end up with basically 1.02 francs, which gets you to the same spot, right? So currency forwards are in general more an expression of an interest rate differential than an actual expected future spot price path. And I get maybe it is accurate in an interest adjusted way, right? So once you factor in the interest, you're either getting extra of or missing out on. It can make sense to say, oh well, I'm buying a dollar. It's going to instead of getting my francs now, I'll get my francs later. I know that they're going to be 2 cents more expensive, but that's okay because in this time frame, I'm going to make 2 cents of interest more relative to owning the franc. So unfortunately, in a sense, forwards aren't all that informative about expected currency movements. They can be. You just have to take out the interest effect. It's a similar situation with gold in commodities, where gold forwards really represent interest rates and not so much beliefs about gold. Because let's imagine that I'm a big believer that gold is going to significantly increase. Well, that would make me want to transact in future gold, right? Commit to get some gold a couple years from now, and then when I go buy it, I get to buy it on sale. But someone else is going to say, oh, well, okay, I will enter into that contract on the other side and earn a bunch of interest, and then I can, right? So if I trade spot gold and then take the other side of the forward, I can get it to all cancel out and earn that interest. So basically buying and storing gold is cheap enough that that earning gold interest in excess of maybe the currency you left to get the gold can make up for that difference in the forward and spot rates. Okay, so in terms of notation, right, we have N is the number of months forward, and then otherwise it's the same where you have the currency J and currency K. Like spot, the forward quotes can be direct or indirect. And there's some examples. So it's common to express a forward in terms of a premium or discount relative to spot. And so that's a percentage increase times 360 to get a daily number. So right, so I have my forward transaction number and my spot transaction number. There's going to be some difference there. Right, so if I go back here, we can see between spot franc and 6-month forward franc, there's a 2 cent difference. Right, so that would be this forward, right, is expressed as 2 cents divided by the spot, which is just basically $1. So that would be that premium then, that forward premium is a 2% premium. Right, this would evaluate to 2%. And then we multiply by 360 days, and you get a little over 6. Right, a little over 6. So yeah, that's informative in the sense that you can see how much more expensive the one currency is forward relative to today. And if it, and obviously that's useful from a trading perspective in that if a currency, if the forward is trading at a 2% premium over 6 months, and that is significantly larger than the interest differential over that period, then that could be suggestive that maybe there's something's out of whack. So in this case, right there, it's a forward premium, right? We have the franc is trading at more. It is more expensive to buy it in the future than in the present. All right. So in general, if we're thinking about cross exchange rates, we can do forward J with respect to K, and then use the the forward exchange rates in this way. There's a couple different ways to do this, right? Because I guess this sort of as follows, right? If I want J over K, then I have over K over J, right? We're doing it backwards because they're on the bottom, right? And if we have K over J, then we're doing it backwards because they're on the bottom. So that's if you're using an American quote. And then if you're using a European quote, then we don't need to be upside down, and it just tracks, right? So for for J over K, you would just do J over K, and for K over J, you would do K over J. But that's because they're in the numerator in this case, and then the denominator in this case. So here's a numerical example of that. So we're thinking about doing a transaction. So we're going to speculate, right, and invest in 5 million francs. And then when the currency moves, the trader will either have made a profit or show a loss. So those are the two scenarios, right? So they forecast that the franc will strengthen and it will be $1.05 instead of $1, right? Or it was about $1 in the example. So then you've got, right? So we're going to enter. Okay, sorry. So the current spot market in this example is $1.05, and we can deliver it forward at $1.08. So, and that's our forecast. Let's see. So, right. So there. Okay. So let's back up and do this slower. So a trader has an economic forecast that they believe the dollar will strengthen relative to the Swiss franc. Okay. So that would mean, right? So if you believe the dollar is going to strengthen, then you want to take delivery of dollars forward, right? Because you'll get dollars at a price that was determined now when the dollar is relatively weaker. No, I've got that backwards, right? So you want to deliver dollars because you can buy them now cheaper and then deliver them later, and then deliver them later. So we've got this spot transaction of $1.05. So they buy francs at spot for $1.05 and deliver it for $1.08. And so there's a 3-cent profit there, right? Right. If I pay $1.05 for francs and then sell them for $1.08 later under the forward contract, then I'm good. But if the dollar depreciated and then it's $1.10, then I have to pay $1.10 and deliver at $1.08, and I end up having a 2-cent loss, right? Multiplied by the total currency transaction. So yeah, I mean it's easy to get turned around with these. I guess the key point being that if you have a currency that you expect to move one way or the other, then a forward position will allow you to lock in effectively at the status quo. And so, and so if you lock in at the status quo, then in the future you'll get to transact at a status quo price, which can be really cheap to buy or really expensive to sell, and relative to the current market price and benefit you. Okay, another important aspect of forwards is non-deliverable forwards. So these are, if I've got a currency that there's capital controls on the currency. Most common example would be the renminbi, right? So if if I want to accept delivery of renminbi 6 months in the future, that's not a transaction I'm allowed to do. And so a way to effectively enable risk management without actually transacting the currency is to do a non-deliverable forward where the change in the currency price is settled via cash. So let's use the dollar as an example. So let's say that I'm accepting a non-deliverable forward of renminbi at 6 months in the future, right? So I would, in the future, deliver dollars and receive renminbi, but I don't actually receive renminbi. What I receive is I receive dollars in the amount of the spot value of renminbi, or the forward value of renminbi relative to the spot at that time, right? So basically, if the currency moves relative to the forward, then that forward contract will either become more valuable or less valuable, just like in this chart, right? So the contract itself will have value one way or the other, and instead of realizing that value by accepting delivery of the currency, you realize that value by accepting an equivalent amount of the original currency. So this can all happen in dollars. And at the end of the day, what you end up having is, it's like a bet where you bet on the price of the value. You bet on the spot value of the renminbi, but the bet is settled in dollars, so no renminbi transactions ever happen. But that's fine from the perspective of risk management, because you could say, okay, well, I'm going to do this bet, and so if the renminbi goes up a lot, I'm going to make quite a bit of money, but in dollars, right, not in renminbi. But then at the same time, I'm going to be needing to purchase a large amount of renminbi in the spot market at that time, and the spot price of renminbi is up, and so I have to pay a lot more for my renminbi than I did in the status quo. But that's okay, because I have dollars delivered from my non-deliverable forward contract that helps offset that cost. So an appropriately sized non-deliverable forward contract could cancel out all of that risk, assuming the timing ends up as expected. So that's a way to provide risk management for currencies that don't really allow financialization at that level. Another important thing to talk about is swap transactions. This is really a risk management story from the perspective of the bank, right? If I'm an industrial firm and I expect to transact in yen, and I enter into a forward contract, right, that I know I'm going to need to sell yen, in the sense because I'm giving yen to a supplier and they give me something, right? So I know I'm going to be reducing my yen holdings at some specific point in the future. I can also accept delivery of yen at that same point in the future on a forward contract. And so from my perspective as the industrial firm, I've done a hedging transaction. I've reduced my risk. But for my counterparty, right, so for the party that agrees to the forward delivery of yen, they may not have an offsetting transaction on the other side. So that's an outright forward. And if it's a bank, right, if they agree to do an outright and forward with an industrial firm, now they're subject to currency risk because they don't necessarily have an industrial transaction to take the other side. So So a bank would prefer, if they're doing outright forwards, that they also have a supply of people doing outright forwards in the short position instead of the long position, so that those things cancel out. And that would matter along each time frame. And of course, that's not really feasible. So they would need to kind of carefully manage, well, how many outright forward transactions do we have at this time frame, and how many short ones in the same currency do we have at a different time frame, and try to get it to pretty reasonably balanced if possible. But you can imagine that's a lot of work. A swap transaction it's a way to mitigate the currency exposure for the bank, where instead of needing to figure out the other side on their own, that it becomes all packaged in the same transaction. For retail investors, another important factor is exchange traded currency funds. So these are they're kind of like mutual funds that trade like stocks. There was a Bitcoin ETF that launched not too long ago that's made some waves at the time. But you can see this is a relatively recent invention, right? The first currency ETFs were created in 2005. But that means essentially that as if I'm a regular retail investor and I've got money in a brokerage account I use to buy stocks I hear about on Jim Cramer or whatever, I can purchase, just like I buy my Ford and buy my Amazon and buy my General Electric, I can buy a Swedish kroner ETF, and that you purchase it like a share, you sell it like a share. It's really a fund. It's purchasing shares in a fund, and that fund owns that currency. So it allows very inexpensive and convenient access to currency transactions. Now, those ETFs don't transact in the foreign exchange market, really, right? That would be an investor buying that ETF using their stockbroker, like Robinhood or Scottrade or Ameritrade or Charles Schwab or whatever their brokerage firm is. And that, so it's sort of using the equity market infrastructure to participate in the foreign exchange market. And that can be really important because, again, as you've highlighted, 90% of the transaction volume in the foreign exchange market is in $10 million chunks or larger. So it's not really set up very well to accommodate retail investors. And so this is a way for, someone to say, oh, I've got $300 and I'm feeling good about the yen. What can I do? Well, this is the way. Okay, that concludes the lecture content for this. So on a separate video, I will go through some of the problems that we're looking at, just quantitative problems related to the couple different kinds of transactions we highlighted in the discussion.